Okay, cool. So we're going to start in just a minute here. I'm going to take my wig off because it's time to get serious. But, you know,
Oh boy.
um, yeah, look at that. Now we're serious. I guess it's 9:02. We can start now. So we're just gonna start, guys, with some intros from the four of us who are presenting today. My name is Michael Huseby. I am the managing partner at TIL. We're a law firm that forms investment funds, including private equity funds. I am based here outside of Seattle, and I'll turn it over to Chris, who is one of the other attorneys at our firm.
Hi, welcome everybody. My name is Chris Schuering. I am also a fund formation attorney with TIL. I am located in West Central Illinois, so downstate. Practiced in Chicago for about 6 years before I had this gray beard, and now I am downstate.
All right, one of you guys got to go. There's only two
All
left.
right, I'll go. Eli Albrecht. I'm at Albrecht Law. I'm an M&A lawyer. We represent, small PE independent sponsors, some kind of larger searchers, doing a bit larger deals. My background is M&A, straight M&A, all the way. At Albrecht Law, we have an M&A department. We have a tax structuring department led by the absolute tax genius, Josh, who you're going to hear from in a moment. And then we recently launched a litigation department to focus on post-closing disputes. And, honored to join Michael and his incredible team here.
You could have dressed up, Ellie.
I thought about it.
Yeah.
It's really embarrassing.
Thanks, Michael, for inviting us on, and thanks everyone for joining and listening in. So I'm going to talk a little bit about tax today, tax structuring when it comes to setting up a PE fund and things to consider. But my name is Josh Siegel, and I work at Albrecht Law with Ellie and lead the tax group. And my background is in tax structuring, tax diligence, and tax opinions, memos, anything tax related, generally in conjunction with the transaction, and look forward to participating on the panel.
All right, cool. So we're going to start kind of high level, and then we're going to move down to specifics here. So I'm going to share my screen. Can somebody let me know when they can see it, please?
I can see it.
Good. Okay, cool. So what is a private equity fund? If you already know, you can kind of ignore me for the next couple of minutes, but I thought it might be helpful to describe how this works. So normally how it starts is you have a principal, which is a fund manager, also GP. These are all synonyms. They might make investments themselves, and they might think, hey, I'm pretty good at investments. Or maybe your family says, I want to invest with you. Can I invest with you? Or something of that nature. So you might want to form a fund. What a fund is really is this is like a very, very simplified version, but the principals form something called a general partner entity, which is typically a Delaware LLC. It can be different, but typically a Delaware LLC. And that entity manages a fund, which is usually a limited partnership, usually in Delaware. Again, this is a very simplified version. You will go and find what are called limited partners, LPs, which are the passive people who are going to give you money. So you're the GP, the principal, you own this general partner entity, which controls a fund, and you find passive investors. Over time, you're going to want to make investments in businesses. And so what you do is you call capital, that's what it's called, you call capital from limited partners, and they contribute capital to the fund. Now, a common misconception, you do not get all the money at once, typically. So if you have a $100 million fund, for example, you're typically going to call something like, let's say 10% of the money at the first capital call to make your first investment, pay some expenses. You're going to call capital over time to make investments. So how do the people running the show get paid? There's two main ways that you get paid. The first one is a management fee. So this is an asset management fee. If you've ever heard of 2 and 20, this is the 2 and the 2 and 20. In a private equity fund, the most typical management fee is 2% of committed capital during what's called the fund's investment period. Chris is going to talk about what the investment period is, but let's just call it the first half of the fund. So 2% of committed capital for the first half of the fund, and 2% of invested capital in the second half of the fund. So once you sell stuff or write it off to zero, basically the base of the management fee goes down. So it's 2%, but it's 2% of a higher number at the beginning, and the fee kind of tapers down over time. That fee is typically paid quarterly in advance. The purpose of the fee is to keep the lights on at the general partner, pay your employees, office space, things of that nature. Now, over time, you will keep calling capital, as I mentioned, and LPs will keep contributing capital to the fund. You'll keep making more investments. Look at that. Now we have 3 investments. Now, what happens when you get cash flow from an investment or you sell an investment? So you have cash now. What do you do with it? There's typically something in the fund agreement or the LPA called a distribution waterfall. And what that does, and we'll send links to kind of more in detailed materials we've prepared on things like waterfalls. We'll send that after the webinar. But the waterfall says, where does the money go? Typically, the first place the money goes is it gives the LPs their money back. So if an LP has contributed $100 to the fund, they're going to get $100 back as kind of the first step of the waterfall. That's called a return of capital. After additional steps, the GP might earn what's called carried interest, and that's a share of the profits of the fund. So a very simple, very standard waterfall in private equity is if you have money to distribute, first, you return the LP money. Second, you give them a preferred return, which is typically around 8%. So it's like a priority return to them. And then you split the profits 80-20. That's one typical way. And another typical way has an extra step in between the second and the third step called a GP catch-up. We don't need to get into that here, although it's quite common. Like I said, we'll send materials afterwards, which will explain what that means. But over time, the GP is going to keep earning these management fees. And then assuming that the fund is profitable, they're going to earn carried interest too. And those are the 2 ways that the GP is getting compensated. Now, if you've been around the block before, you're going to say, wrong, you don't send all this to the general partner. Where's the management company? I know usually there's something called a management company, which is a separate entity. That's what gets the management fees, but this is just for the sake of simplicity. Over time, as the fund winds down and you sell assets, so you'll sell the asset. You'll make sure that the LPs have received a return of capital. You might get some carried interest up to the GP level. You're continually selling investments, and eventually all your investments are gone. And so at that point, in private equity, typically, you have a closed-end fund, which means that the fund lasts, let's say, 10 years. At the end of the 10 years, or perhaps beforehand, you will already start fund 2, where you basically do everything over again. And there's specific rules about when you're allowed to start fund 2. The short answer is you can typically start getting fund 2 off the ground about halfway through the first fund after the investment period is over. Chris will, here's the segue. Now Chris is going to talk about the lifespan of a typical private equity fund. And so just bear with me really quickly, please.
Great. Yeah.
Share my screen. Oh, you're already ready. Don't even need the graphic.
No, I'll go ahead and start talking. So I am I'm going to try to run us through a 12-year lifespan of a PE fund sponsor in about 5 minutes or less. So buckle in. We're going to move pretty quick.
Can you see this, Chris? Is it big enough?
It is. Yes, I can.
Okay, cool.
I'm going to try to make it a little bit bigger though, so I can read it. So the 3 main periods of there we go. 3 main periods of a fund, and they overlap. So we've got the fundraising period, the investment period, and the fund term. So this timeline encompasses all 3 of those. We're going to talk through all of those numbered points, but first, just briefly. So fundraising period starts prior to the initial closing, and in a PE fund usually lasts about 12 to 18 months after the initial closing date. Then we've got what's called the investment period, which for a PE fund is usually half of the life of the fund itself. So if you have a 10-year term on your fund, you would generally expect to see a 5-year investment period starting from the final closing date. And then the fund term itself on a PE fund is often a 10-year period would be market. So with that, let's flip to this timeline. You'll see point number 1. pre-closing fundraising. So prior to the first closing, lots of activity happens. You're gonna research fund terms and general structure, talk with your attorney and your tax advisors, tax attorneys about the structure itself. Draft a preliminary pitch deck, your marketing deck. Your attorneys will review that and give you some feedback and guidance to make sure that you're not violating any rules. With your pitch deck, you're going to find a lawyer and start drafting what's called a comprehensive summary of terms. Lawyers will then start working on long form documents, which would include the LPA, subscription documents, and sometimes a PPM, depending on your particular needs. At that point, the lawyer is also going to start forming legal entities and preparing for securities filings and drafting ancillary documents. You'll open bank accounts. And then at this point, if necessary, you would also start negotiating with investors. So if you have anchor investors or large investors that request side letters or additional special treatment, those negotiations would happen in this phase. And then, of course, you would begin collecting signed subscription documents from the investors. You don't countersign those yet. You receive signed documents from the LPs. And then we're going to move on to point number 2 on the timeline, which is the initial closing date. So this is the point when you would countersign those first subscription documents and admit the first LPs into the fund. You're also going to sign the fund's LPA, which is the primary fund document, the limited partnership agreement. You'll sign some ancillary documents like closing resolutions. And then at that point, the lawyers will take over and file some documents, a document called the Form D with the SEC, and we'll also make some blue sky filings. Then at that point, let's look at item number 3, initial capital call. So you can start calling capital from investors as soon as you've had that initial closing date. So many funds do that within a few days of that initial closing date. That first capital call can often covers the formation expenses, the initial quarter's management fee, reserves for future expenses, and of course the equity that you need to start making investments. And we'll look at item number 4, the final closing date. So you'll see on the timeline that there's a 12 to 18 month period of time between the initial closing date and the final closing date. So we're going to talk a little bit about final closing date. The fund can no longer accept new investors or increase in commitments after that final closing date. And as I mentioned, that typically happens 12 to 18 months from the initial closing date. From there, we're going to start into the investment period. Point number 5 shows when the investment period ends. So once the capital has been raised, you'll start calling capital, you'll deploy capital. So you'll bring in the guys like Eli and Josh to work on your deals. And then we get to the spot, item number 5, where the investment period ends. So investment period typically, as I mentioned, lasts half of the fund's life, so about 5 years in a 10-year fund. And after the investment period ends, the fund can still call capital for expenses, follow-on investments, funds needed to complete deals that are in process, but that would be it. And then that's also a point in time when a management fee step down generally happens. So for a PE fund, that's usually an adjustment to the base. It's a base adjustment. And then from there, after item 5, between item 5 and item 6, you'll see item 6 is when the fund term ends. And in that 5-year period after the investment period, you'll start to exit or harvest your investments. Again, you'll bring in guys like Ellie and Josh to work on sell-side transactions. You will exit those investments during that period of time. And then when you get to the end of the term, if there's anything left, you would liquidate those, dissolve the entity, and make your final distributions. So that is a 12-year plus period. And I don't know, how'd I do? 5 minutes?
That was pretty good. It was like 5 minutes. Yeah, that was good.
All right.
That was good. Yeah, so now Chris and I are going to quickly hit 2 topics that we've seen coming up recently. One, which I'll talk about, dovetails nicely with the chart here, is that as we mentioned, a closed-end fund like this is like 99% of private equity funds. Like, this is what private equity funds do. That being said, some people have started saying, you know what, I don't want a closed-end private equity fund. I want an open-ended evergreen private equity fund. So basically the thing lasts forever. You basically, there is no stage 6, there's no stage 5, There's no stage 4. Those are just all out the window. You just chop off the end of the chart and the fund lasts forever. So like, how does that work? So an LP doesn't want to give you money and then never know when they're going to get it back. In a closed-end fund, okay, at the end of this, like, we're going to give you your money back. It's a long time. It's 10 years, 12 years, but they'll get the money back. And in a fund that lasts forever, there is no date like that. So what you have instead in an open-ended fund or an evergreen fund is a right of redemption, a right for LPs to ask for their money back. So the LPs can say, send me my money back. And you say, okay. Now there are typically two restrictions on withdrawing your money. One is called a lockup period. So you enter the fund as an LP, your capital will typically be locked up for a period. Now in a hedge fund, that might be like a year, maybe 2 years. The thing about private equity funds is you're not holding shares of Apple or treasuries. You're holding illiquid businesses. So you need to engineer some illiquidity for your LPs as well. So instead of a lockup period of like a year for a hedge fund, you might want to lock a period of 3 years or 4 years or 5 years, or, it's up to you. It's up to what you can market. But you want to allow time for you to make improvements to these businesses and make them saleable before you allow LPs to start withdrawing money. This is a very important point that people who try to think about open-ended funds, if you don't think about this, you're going to end up in hot water, because you could have people trying to withdraw money after a year and you're like, well, what do we do? Like, we have to fire sell this business that you don't want to sell. You might get a bad price. It's a bad outcome for everybody. So if you're going to do an open-ended private equity fund, a forever fund, you need a lockup period. Just as important, or maybe even more important, is what's called a gate. And a gate says, fine, your lockup period is over. You can start withdrawing your money, but you can only withdraw some of the money. And so, for example, you could say, after 5 years, you can withdraw money, but you're going to be subject to a 25% gate annually. So in other words, you can go from $100, which is your capital account, down to 75, down to 50, down to 25, down to 0. That's just one example. You can have what's called an investor by investor gate, where the gate is calculated per investor. You can have a fund-wide gate, where you say, the NAV of the fund can't be drawn down by more than 10% a year, or whatever you want. But that's important as well to avoid the run on the bank situation. If you need to sell an asset, that gives you the time to either, you'll have cash reserves so that, you don't have to sell the asset. You could maybe try to find other LPs to join the fund. You could engineer a situation such that you don't need to sell assets that you don't want to sell. So open-end private equity funds are allowed. They're not illegal. You can certainly do them, but you want to be very careful about managing liquidity. So that's just the big warning sign I would say. We're perfectly fine forming open-ended private equity funds. Just need to have these. Just need to take these things into account. So that's the end of my warning disclaimer on evergreen illiquid funds. By the way, same thing applies to illiquid to open-ended funds in real estate, for example. Anything that's illiquid, you want to have strong lockups and gates. Now, final new point is Chris to talk about the new change to 506C, and then we will turn it over to Ellie and Josh.
Yeah, great. Thanks. I'm going to talk a little bit about a SEC no action letter that was issued in March of this year regarding Rule 506C. So just a brief overview. As you probably know, there are, if you're in the PE space, there are several federal and state laws that fund sponsors need to comply with. One of those is the Securities Act. It applies to anyone selling securities. So you either need to register the securities, which you don't want to do, or sell them pursuant to an exemption. And most investment funds rely on exemptions found in Reg D, and specifically Rule 506B and 506C. So with 506B, general solicitations are prohibited, but investors can self-certify their accredited investor status. So you can only solicit investors that you have a pre-existing substantive relationship with. However, you don't have to take action to verify their status. They can sign off on that. 506C is different. 506C allows general solicitations. However, the fund sponsor has to take reasonable steps to verify, that's the magic language, reasonable steps to verify that the investors are in fact accredited. There are several different ways to do this. There are third-party providers and platforms that provide services that will run through the investor verification process. Investors can get letters from their lawyers or CPAs, but nonetheless, it's a hurdle. There's a bit of friction. There's another step. So that's where this SEC guidance comes in. It might make the path to compliance a little bit easier. So first, I want to say that I want to point out that an SEC no action letter is only interpretive guidance. The SEC makes it very clear that a no action letter has no legal force or effect. It's only a staff interpretation of a specific set of facts. However, we as attorneys rely on these. So as our clients come to us with issues or ideas or suggestions, we do look to staff guidance when we guide them. So this is important and useful. So let me cut to the chase. What did they say? The SEC letter suggests that an issuer can assume that investors in a 506c offering are accredited if all of the following are true. So 3 things. The minimum investment must be $200,000 for individuals and $1 million for entities. Second, the investor must make written reps and warranties that the investment is not financed by a third party and that the investor is accredited. And then the third thing is that the issuer, the PE fund sponsor, must have no actual knowledge that these investor reps and warranties are untrue. Obviously, if an investor signs off saying they're accredited, but you know they're not, then you can't rely on this exemption. So what's that mean? So the good news here is that sponsors following the guidance in this no action letter may now have an easier path to investor verification in a 506c offering. So it is very helpful. I'm a lawyer, so one more time, I'm going to point out that this no action letter is not a law. So make sure that you work with your attorney before implementing this guidance. That's and I'm gonna
appreciate that. And so for a lot of our bigger funds, if your minimums are like going to be $1 million because you're raising a big fund or more, then there's really no reason not to do 506c at this point. You can just kind of hardwire it in, and then even if you don't want to advertise per se, you can post on LinkedIn and such without worrying about it. So it's a really nice update. Appreciate that, Chris, Ellie, and Josh. We'll turn it over to you guys.
All right. So first of all, amazing presentation, Michael and Chris. I want to offer my personal endorsement for you guys. I've worked with you guys
appreciate you, man.
A few times, and worked with a lot of funds lawyers in big law as well. And you guys are the best.
I appreciate that.
Yeah. So let's talk about the private equity acquisition. So, and once you guys have formed your fund with Michael and Chris, Chris gave a great overview of the life cycle of the fund. And so you want to make those new investments. Like, how do you do it? That's when you guys usually come over to the M&A lawyer. And let me just clarify that, and this was a good question by Daryl in the comments and in the Q&A, which feel free to drop questions and answers here for us as we go along. But this applies to independent sponsors as well. The only difference between independent sponsors and PE is that PE will create a broader fund for many, many different investment platforms and add-ons, whereas independent sponsors raise little mini PE funds for each acquisition, and then will repeat little SPVs for each of their platform acquisitions. It's really doing it on hard mode, but it creates a track record for then the independent sponsors to go and raise a full fund. But it's very, very challenging to create a fund and raise for each transaction, although we have some great clients who have been very successful at it. So when I talk about PE, I'm also talking about independent sponsors here. And then the second point, so I'm going to cover briefly, what is the timeline? What can you expect from the acquisition process? And then we're going to talk about some of the kind of real primary terms in the LOI and how PE independent sponsors can beat their competition by leaning into their strengths here. And then lastly, Josh is going to talk about the tax issues in a fund and acquisition, and then we're going to go into the trends toward the end of the call. But what can you expect from the acquisition process? I break the acquisition process down into four different steps, 4 different stages. So when a sponsor starts getting serious about a target, they usually come to us when they're ready to submit an LOI or an IOI or start marking up an auction draft. And so first, you have the definitive documents in an acquisition. That's like your purchase agreement, your rollover agreement, your restrictive covenants agreements, your lease. The list goes on, but these are really the documents that guide the transaction. 2, you have the legal diligence process. That's where your lawyer goes through kind of all the legal aspects, it flags the legal risks. And then very, very importantly, something we've been really stressing and emphasizing to clients lately is doing tax diligence. That's run by Josh out of our tax department. And Josh, we've been seeing a lot of tax risks come up in these transactions that cost real money after closing. So we're pushing our clients to do that tax diligence in the diligence process. And that's the second bucket. The third bucket we call the buyer co-structure. Now, if you've created a blanket, like a main PE fund with Michael and Chris, then this is going to be a more simple process of just creating a new investment vehicle below to either pull the assets in or pull the stock or equity in of the target. And Josh in our tax structuring department is very involved in creating the right tax structure for that buyer co-structure as well. And then the fourth, if I know my fingers right, the fourth bucket is the debt docs. So for almost every transaction, the fund or the sponsor is going to take out debt leveraging the business that they're acquiring. This is called a leverage buyout. You're basically using the balance sheet of the business that you're acquiring to take out debt in order to acquire the business. It's kind of magical when you actually think about it, but you're taking debt from the business you're buying to buy that business. Don't question it, just do it. It works sometimes if you don't get over leveraged. So that's kind of the debt process. There are debt documents, there's negotiations over debt term sheets, and a lot involved in that process. We have a great finance lawyer who joins our team to help with that process. So those are the 4 buckets in the timeline of a transaction. Usually takes about 60 to 90 days, we find, to get everything done. Now, let's talk about the initial phase. Once you've raised that fund and you have your commitments, there are 3 ways you can kind of enter into discussions with a seller. An IOI, an indication of intent, an LOI, a letter of intent, and an auction draft. Now, LOI and IOI, people are probably very familiar with those concepts. An auction draft is something that started happening more and more in the lower middle market over the last 10 years. A seller will say, hey, instead of taking LOIs, I'm just going to put out my preferred purchase agreement. And then if any buyer is serious, they're going to send me back a marked up purchase agreement. Now, that generally costs $10,000 to $15,000 for a lawyer to do, maybe $30,000 for a big law lawyer to do if they're billing, $1,800 an hour. So at that point, you really want to have your lawyer on retainer so that you can compete for those deals, because the seller is going to look at your markup of the auction draft and they're going to determine whether they want to move forward with you if you're reasonable on the terms and your price is in line with their expectations. It's become a little less popular as the M&A market has slowed in the last couple of years, but was very popular for the prior 10 years in the lower middle market. And so briefly, what is the LOI or IOI that's more popular? LOI is a letter of intent. This is a non-binding document that's like a roadmap for your deal. I often say this is non-binding, but it's reputationally binding. If you're a serial acquirer and you're in the market, you do not want to get a reputation for throwing out terms in an LOI and then walking them back or retrading them. It's not a good look. So it is binding on your reputation. There are some provisions in the LOI that are binding, such as exclusivity, choice of law, expenses, that sort of thing, but mostly it is non-binding. And then finally, in the structure of the LOI itself, really the purchase price is the meat of it. And PE groups and independent sponsor groups have a major advantage over searchers or independent buyers and even like large strategics, because they can offer something called rollover. They can also offer earnout, but rollover is really the most powerful tool that PE groups and independent sponsors can use. And this, not going to encroach on Josh's territory, but this is a tax deferred amount of the purchase price that is rolled into equity in the buyer. So that's rolled into equity in that PE fund's platform. This can end up being very, very valuable for a seller, not only because there's tax benefits, but also it gives them an opportunity to benefit from a roll-up and an eventual sale. And sellers really, really like this. This is, something that PE groups and independent sponsors have an opportunity to do that others don't. And again, the last point is that, PE groups have gotten a reputation for offering higher prices. This is because it's double the leverage and double the fees, right? PE groups can leverage at the fund level, sometimes, lines of credit or even leverage in the fund, and leverage at the opco level, at the target level. So they can sometimes double leverage to offer a higher price, but they also are making a lot more fees, both from the target. They're generally making a management fee that's like generally a market of 5.5% on EBITDA, on TTM EBITDA. They're also making acquisition fees on new add-on acquisitions. They're sometimes making debt fees on taking on new debt, and then closing fees on selling the target. So PE groups, as a partner at my old law firm, told me, fees make the private equity world go around. So there's a lot of fees, and so sometimes they can rationalize paying higher prices and lower returns to investors. That's kind of the dirty secret, because they're making more fees. So, that sort of wraps up. I'll just answer live this rollover equity question from Ben. He says, with rollover equities, there typically an intermediate holdco between the fund to effectuate this. Yes. So if you remember Michael's chart, there was the fund, and then there was multiple different investments. And so each one of those investments are a platform. And usually the rollover equity is rolled into that individual platform. The rollover holder generally doesn't have access to the equity in the other investments. However, on rare occasions, I have seen private equity groups even offer rollover into the fund, like into part of the GP carry. Although it's incredibly rare to do that, the seller in that deal was integral, and they wanted to pull him into the PE group itself. So they offered him rollover in the carry, but usually it's of that platform. Michael, you want to jump in and answer that one as well?
Sorry, which one? I've been typing away like a maniac.
Oh, okay. I saw you typing. I thought maybe you wanted to answer. But anyway, that I think I've used
the one from Ben or another one.
That was the one for Ben on.
No, you take the one from Ben. I was reading this other one, which was asking, are the fees then reduced against the management fee they would receive from LPs? The answer is yes. Typically, or often, you'll typically have what's called a transaction fee offset in the fund documents. And the idea is that if you're earning some fee downstairs, then the management fee upstairs is going to be reduced by an equal amount. And there's all sorts of like fancy things you do. Like in our docs, we say it'll be reduced, but the management fee can't get more than a 50% haircut in any quarter. So you still have some operating cash to continue, keeping the lights on. But yes, there's typically, but not always, some sort of reduction.
Yep. And that's what I found as well. However, there are a lot of places where PE funds pull fees and independent sponsors pull fees. And honestly, I'm a big fan of fees. I advocate for fees. I think.
Are you a lawyer, Ellie?
It's a wonderful thing. I take fees. The lender takes fees. It seems like everyone takes fees, except everyone's trying to pressure the sponsor not to take fees. Like what? Everyone should take fees. The lender, the broker, the lawyer, the investors, but not the sponsor. Fees keep the lights on and allow us to do more transactions in the future. Not a popular opinion among lenders, but yeah.
We won't let it in the call.
Josh, you want to take it?
Yeah, I'll jump in. I'll jump in to to talk about my favorite topic, taxes. And some people find it boring, but I think here in the tax world, you can get a really big bang for your buck in terms of planning properly. So from a structuring standpoint, I really think, I like to break it down into two pieces, right? There's a top side structuring, which is structuring at the fund level. And then there's the acquisition structure, the deal structure, which is the actual deal that you're investing in and how that's structured, and then how those two interact. So the funds, on Michael's chart are generally in what we call flow through structure. They're LLCs or actual partnerships. From a tax perspective, everything flows through, and the LPs and GPs get a K1 at the end of the day for their allocation of the economics. At the for the top side structuring, the fund structure, it's very important to know who your LPs are. A lot of the bigger funds have nonprofits, educational institutions, family foundations, a lot of very large nonprofits, and you see the same very large nonprofits on the cap table of a lot of the big PE funds. And nonprofits, there's something called unrelated business income tax, and so any foreign investor or any nonprofit investor is going to want to come in through what's called a blocker. So that can add a little bit of complexity to the structure chart that Michael showed. So again, I have a few minutes here. It's too little time to, we could have a whole, 30 minutes on blockers and this topic. And, but again, it's important to reach out to a tax attorney as well as fund investment attorney or fund formation attorney, I should say, when going through this process, because who your LPs are, it does have an impact on what structure, that I would recommend. And then another point I want to touch on the upstairs and the fund structuring is the management fee. Management fee, again, it starts out as a 2%, you get cash and it's to operate the business, pay salaries, pay your rent. And that's oftentimes very important in the beginning of a fund life cycle. There's an option which can, or, is in some funds and not in others, but there's a concept of management fee conversion where, at the fund's option, you can take this ordinary, that's treated as ordinary income, almost, similar to wages, right? You're getting a fee for the services you're performing, but with the management fee conversion, you can say, hey, listen, we're going to forego this 2% fee and we're going to increase our carry from 20% to, there's not a firm amount that translates into, but essentially convert ordinary income to additional capital gain. And there's some requirements in how long you have the investments and how long you hold your interest in the partnership. But essentially, management fee conversion is very powerful to, really get significantly more money than what the 2% in cash would be worth. Michael, I don't know quickly if you want to talk about how often you see that in funds or,
All
your
the
clients,
time.
are they asking? Yeah.
Yeah, we do it all
Me
the
too.
time.
Yeah.
But I guess one point which is kind of responsive to somebody's question is, and this is what I said in the comments, I think if the government kills the cap gains treatment of carried interest, I have to imagine this whole thing kind of goes away, or at least decreases in popularity significantly, because it does let you there's an element of tax deferral. There's an element of liquidity. Like you get to keep more liquidity because you're basically not, usually you're doing it to fund your GP commitment. And so the idea is you don't have to put in your money now. You can just waive fees over time. But the conversion from ordinary to capital gains is a big reason why people do it. So it might make it less common. We'll see what happens. It's hard to predict changes like this.
Yeah, I
nowadays.
agree. But also, like, you and to be clear, you can't convert it like the day, if you're going to have a 10x exit, you can't convert the day before. You have to convert at a time where there's still some business risk before you are certain that like this is a grand slam. But I've seen it with large VC funds that, I mean, you can kind of tell when you have the, you're at the beginning of the increase of the hockey stick. So you
Yeah.
don't want to do it at the top. But I would say that, when I've seen it done, um, it's going to that the percentage of carry that you get the increase in is
Yeah.
worth significantly more than the
Yeah.
2% of cash as a fee. So even if you lost the, preferred treatment, it still would result in significantly more economic benefit to do the conversion. Um, so I'll move on quickly. Yeah, so top side, know who your LPs are, and that's going to translate into certain structural changes that are very important from a tax perspective. And then there's the, downstairs structuring, the acquisition structuring, right? And sometimes it's dependent on what the target entity is set up as, right? Are you buying a C corp? Are you buying an LLC? Is it an S corp? Right? And so it's really dependent on target and where you find them. But there's a lot of structuring options that are available. Generally, a fund will want to buy a deal structured as a purchase of assets, whether that's buying a partnership interest, buying an LLC interest, buying 100% of an LLC. There's a number of different iterations that are treated as purchasing assets from a tax perspective, but essentially purchasing assets or any iteration thereof, even if you're buying a legal entity that's treated as buying assets, you get a step up in basis in those assets. And it's very important for the economics. Most PE funds are layering in the tax impact into their greater economic model. And so when you get a step up in basis, you're looking at the balance sheet, what amount's going to go to shorter live assets, what can I write off in year one, what's going to go to goodwill, and I have to amortize over 15 years. But you're really looking at what is the present value of the future depreciation amortization that I'm getting from this step up, and how does that impact my model? What tax shield am I getting over time? So these are all really important tax considerations, in the modeling of the deal and investment. But a lot of that is contingent on the acquisition structure. If you buy C Corp stock, your basis is stuck in the stock and you don't get to step up any of the basis in the assets. So oftentimes you'll hear in the market that, if the same deal was structured as acquiring assets versus acquiring C Corp stock, you might pay, 15-20% less for the C Corp stock because it's worth less economically because you're not getting the step up in basis. So all things to, tax really, it's obviously important to focus on the tax, but it does figure into the overall economics of the deal as well. So I think we're a bit over time, but hopefully that gives you some food for thought. And I'd love it if you all reach out with any specific questions.
Yeah, appreciate it, guys. So just to bring it home, as we're quite over time, it appears. So again, two law firms here. We're TIL, the investments lawyers. We'll shoot you a couple things. We'll send an email to everybody after this with our websites and whatever. We'll also include some articles that kind of go into more depth on some of these particular topics. It's kind of hard to, explain the whole thing here in such a short time. So we'll send that. We'll also send um, the graphics that we shared today. Any last words from you, Ellie or Josh?
Is there I see someone asking if there's a recording available.
I believe so. I'll put it that we're recording it, right? It said recording in progress, so I assume I'm pretty sure we're
it looks like
recording it.
Yeah, it was great to join you. Obviously, this is like such a light touch on a very complex, two very complex topics. We're always available. You can reach me at LEELI@albrecht.law, not .com, and Josh at albrecht.law, or on our website. And always available if you have any questions. And looking forward to working with everybody.
All right, sounds good. Thanks, everybody. Appreciate it.
All right.
all right.
Bye.
Thank you.
Thanks, Chris. Thanks, Josh.
Thanks, guys. Bye-bye.